Your portfolio didn't become unstable overnight. The price swings you see are not chaos. They are adjustments to something that was already mispriced. The market is not suddenly nervous. It is recognizing a cost that was ignored while stability felt permanent. Every sharp move reflects a quiet correction in expectations about money, growth, and time. What feels like volatility is actually a negotiation happening in public. Assets are not moving randomly. They are being reassessed against a reality that changed earlier, long before prices reacted, and long before most investors noticed the shift quietly beneath familiar headlines and daily noise. Most investors are told volatility is emotion. Fear rises, confidence falls, and prices follow sentiment. This explanation feels safe because it keeps the system understandable. If markets swing because people panic, stability simply returns when confidence returns. Intelligent people accept this story because it preserves control. It suggests patience is protection, and long horizons neutralize risk. But this framing quietly hides a deeper misalignment. Prices are not reacting to moods alone. They are recalculating assumptions about liquidity, future earnings, borrowing costs, and the true price of certainty in an environment where stability was artificially sustained for longer than markets admitted. What people notice first is speed. Prices move faster than explanations. Headlines arrive after losses have already settled into portfolios. The visible effect feels sudden because recognition happens all at once. A company misses expectations and valuation compresses. A bond yield shifts and entire sectors reprice within hours. Retirement accounts fluctuate without warning. Yet these movements are not new information entering the market. They are delayed acknowledgments of conditions that accumulated quietly. Volatility becomes visible only when consensus breaks, revealing that agreement about value was temporary, conditional, and dependent on assumptions no longer holding together beneath surface liquidity expectations everywhere. The invisible mechanism is repricing of time itself. For years, capital assumed growth would arrive predictably, and financing would remain cheap. Future profits were valued as if uncertainty had permanently declined. When money is inexpensive, risk appears distant. Duration stretches. Investors pay today for earnings expected far ahead. But when financing conditions change, the distance between present and future suddenly matters. Cash flows once considered reliable become uncertain. Long promises shrink in value. The adjustment looks like volatility, yet it is simply the market recalculating how much tomorrow is actually worth compared with holding liquidity today under new risk assumptions. Investors respond to falling prices by seeking safety in the same assets that benefited from earlier assumptions. They average down, extend horizons, and repeat strategies that once worked. The behavior feels rational because it succeeded during stability. Yet each attempt to restore past valuations reinforces dependence on conditions that no longer exist. Capital remains allocated according to outdated expectations. Portfolios become anchored to narratives instead of changing realities. This behavioral trap slows recognition. Losses deepen gradually, not explosively. People believe patience will reverse repricing, even as the underlying reference point for value continues shifting away from prior comfort zones entirely. Over time, institutions must acknowledge these adjustments. Funds rebalance. Lenders tighten standards. Risk models update assumptions that were once unquestioned. This creates structural lock-in. As capital rotates, liquidity concentrates in fewer perceived safe areas, amplifying movement elsewhere. Prices fall not only because expectations change, but because participation narrows. Markets become sensitive to smaller triggers. The exit door appears crowded long after repricing begins. Investors discover that flexibility was lost while conditions seemed calm. The system does not collapse. It reorders access to capital, leaving some assets permanently discounted relative to new funding realities and risk tolerance levels across markets. This is where ordinary behavior collides with structural change. Saving consistently, avoiding speculation, and following diversified allocation once signaled prudence. Many investors did exactly what responsible guidance recommended. They reduced debt, invested regularly, and trusted long-term compounding. None of those actions were irrational, yet they were calibrated for a pricing environment that assumed abundant liquidity and predictable expansion. When repricing begins, discipline alone cannot preserve outcomes. Stability strategies become exposed to forces outside personal decision-making. Individuals realize they participated in a system whose rules were silently rewritten beneath familiar expectations of safety and market permanence over decades prior. Recognition often arrives quietly. A portfolio that once recovered quickly now struggles to regain previous highs. Gains take longer to rebuild than losses took to appear. Investors check balances more frequently, searching for reassurance. News explanations feel incomplete. Something deeper seems to be adjusting beneath daily price action. This recognition produces unease rather than panic. People sense the framework supporting valuation has shifted. The market is not punishing participants. It is redistributing confidence according to updated assumptions about scarcity, growth reliability, and the durability of financial promises extending into uncertain futures, where time value and capital access diverge gradually now. At this stage, volatility feels exhausting rather than shocking. Movement persists even without dramatic news. Investors wait for calm that does not fully return. The cost begins to appear in lost optionality. Opportunities once affordable become unreachable as valuations reset unevenly. Cash held for safety loses relative purchasing power against repriced assets. Risk tolerance narrows because recovery timelines extend. The realization forms slowly. The market is not fluctuating around fair value. Fair value itself is moving away from previous expectations, carrying future possibilities with it beyond current participation levels and investor planning horizons in subtle, irreversible ways over time now. The irreversible cost is rarely immediate loss. It appears as time spent waiting for conditions that no longer apply. Capital remains committed while alternatives evolve elsewhere. Years pass maintaining positions designed for a different regime. Flexibility declines unnoticed. Choices narrow without explicit decisions being made. Investors become managers of exposure rather than owners of opportunity. The repricing process quietly reallocates leverage toward those positioned for new assumptions. Others hold assets that still function, yet no longer compound with the same efficiency. The difference accumulates invisibly across years, reducing future freedom relative to emerging opportunities outside prior market structures entirely today. What emerges is recognition that markets are not breaking. They are updating the price of certainty itself. Stability was never free. It was subsidized by conditions that masked risk distribution. As those supports fade, pricing becomes honest again. Honesty feels unstable when expectations were anchored to permanence. Investors search for equilibrium, unaware equilibrium is being recalculated continuously. The system is revealing dependency relationships between growth, liquidity, and confidence. Each adjustment clarifies that valuation is less about optimism and more about the cost of sustaining financial promises across uncertain time horizons under evolving macroeconomic constraints beyond individual control or prediction today. And this repricing does not end with equities or bonds. Housing, wages, and business investment adjust along the same logic. Every asset reflects assumptions about future stability. When those assumptions shift, repricing spreads gradually through connected systems. The effects appear disconnected at first, then patterns emerge across sectors previously considered unrelated. Investors begin to sense a broader transition underway. The market is not reacting to a single event. It is aligning present value with a future still being negotiated in real time between capital availability and economic reality across global funding networks, adjusting expectations continuously beneath daily price movements everywhere. So what feels like instability may be recognition arriving late. Prices are catching up to conditions already shaping decisions beneath awareness. The market is not asking whether assets should move. It is determining how long previous assumptions can survive under new constraints. Each fluctuation is a message about changing relationships between money and time. Investors interpret volatility as noise, yet noise persists because repricing continues unfinished. The adjustment has not reached equilibrium. It is still unfolding quietly, redefining value while participation continues, as if the old framework remains intact beyond current understanding, and the realization has only begun for markets. If you're interested in how money, incentives, and behavior really interact, you may want to follow Finance Simplified.